So hello everyone. In this particular project, I'm going to discuss mostly about state of Indian economy, the monetary policy, then credit tightening and future policy outlook. So this particular video is going to be more practical in the sense that you'll be able to link up some of the concepts that were taught in the classes. So before delving deeper into the credit tightening and future policy outlook, let us first discuss the state of Indian economy. Currently, the our repo rate is around 6.25%. So RBI has recently decreased the repo rate by 25 basis point. We have seen a massive outflow of equity because of various reasons. The reasons could be the earnings slowdown of the Indian companies during the December quarter, and then there were various headwinds in the Indian economy. Because of that, the growth of the Indian economy slowed down to around 6.4 to 6.5%. And so these were some of the reasons, these are some of the, the current conditions of this particular Indian economy. Now, before, delving deep into this, credit tightening and monetary policy, let us first discuss some of the concepts that were taught in the class, and I want to elaborate it further. So the first concept is Basel III norms. So what are the features of the Basel III norms? So basically, Basel III norms, these are the norms that has been created by the Committee on Basel Banking Supervision. And so they aim to strengthen the a global banking system and promote financial stability. Some of the components of the Basel norms are minimum ratio of capital to risk weighted assets. It's around 8%, and 2.5% of capital conservation buffer is also required. The tier 1 capital has to be around 6%. Now, in case of India, the CR has to be around 9% and plus 2%, 2.5% capital conversion buffer. Now, how does this risk-weighted assets work? Basically, what happens is that whenever a loan or asset is assigned a particular risk percentage weight, and so let's say in case of cash and government bonds, there it is assigned very low weight because it's risk-free. For home loans, it's 35% risk weight. For corporate loans, it's 100% risk weight. And for unsecured loan, it's 150% risk weight. So one of the example calculation that we can see is of tier 1 capital. Let's say there, it is of 5,000 crore. Tier 2 capital is 2,000 crore. And the risk weighted asset, so is 50,000 crore. So the after calculating this, it comes out to be 14%, which is higher than the 9% requirement of the RBI. So basically, banks can lend out the money. Otherwise, if the if let's say it would have been very lower than 9%, then the RBI would have asked them to keep more capital or stop lending. So these are the things that are required for Basel III norms. Now, what are the domestically systematically important banks? So these are, currently the three banks that are too big to fail, meaning that they can cause potential economic disruption if they fail. And so what they have to do is that they have to, they are subjected to additional regulatory measures like capital buffer, stress test, and recovery and resolution planning. And so, what is the selection process? The major, criteria is that the banks should have the assets over 2% of the GDP. And so they have, subscribed various, criteria, uh, like as you can see here, the State Bank of India is kept in the fourth bucket, and the HDFC Bank has been kept under, second bucket. So they have to, keep additional common equity tier capital of around 0.40%, and then ICICI Bank has to keep around 0.20%. Now, why have discussed about the risk-weighted assets and domestic systematically important banks. So what has happened is that there are various impact of monetary policy and credit tightening. So what happened is that in 2023, the RBI came with a regulation that they tightened the credit policy. What they did was that they asked the bankers or the lenders and to actually keep aside higher percentage of risk weighted asset. So what they did was that they raised the risk weighted for the lenders and non-banking financial company by 25 percentage point to 125% on retail loans. On credit card exposures, they hiked the risk weight by 25% to 150% and 125% for banks and NBFCs. What has happened is that because of this, there was slowdown in the loan growth, and that has created a new wave of concerns. So from 2023 to, if you see to the 2024 or 25, February, the bank's personal loan has, growth has more than half. They have become half to 8.5% from 19.5% a year ago. And because of that, there is a something, there is a kind of a slowdown. And as you can see, it has been reflected in the slowdown in the, economic growth, in our economic growth, which is, around 6.4% currently. And so because of that, what has happened is that, now RBI is thinking of easing the credit tightening. So recently, RBI, they have done is that they have dialed back the strict loan rules for microcredit non-banking lenders. Moreover, what has happened in the current scenario is that India's inflation rate has also dipped, and it has dipped to 3.61% below, the central bank's target. So they were thinking about, 4 to 5%, but it has dipped to, say 3.6%. Moreover, what has happened, just this news has come just, today itself, that India's core sector growth has fallen to 5 months low of 2.9% in February. What has happened is that, there is a sort of a deceleration in the output of coal, refinery products, and cement. And on the other hand, in sectors like fertilizers, steel, and electricity, they have grown at a decent rate. But again, there is, since the overall, growth has fallen from 5.1% in January to 2.9% in February. So there is a sort of concern. So, what would be the future policy outlook? So, according to me, the future policy, would be that the RBI in the upcoming monetary, policy review, they are going to at least reduce the repo rate by 25 to 50 basis points because they want the loan to grow and they want further easing of this credit policy because the economy is slowing down and the in order to for infrastructure sector to grow or other sector to grow, they need to lend out more money. So there would be easing. It has been, as we have seen for the before, the easing has been done, and as we move ahead, there could be easing. Moreover, in the equity market sector, what is going? There are some risks with respect to Donald Trump's policy of of basically import taxations and all of this. But what I believe is that currently RBI is going to held tight to its monetary policy easing of by easing, let's say 25 basis point to 50 basis point. Furthermore, what I think is that even though there is uncertainty in the global market, but India's valuations have decreased. In valuations, have actually decreased because of many reasons like, there has been, most of the stocks have fallen around 20 to 40%. So, the valuation actually looks attractive. Moreover, what has happened is that in the December quarter, there were earnings slowdown. In the January to March quarter, there could be, the company's earning could show good potential. And because of that, again, the foreign institutional investors and the foreign portfolios investor can again come back. That can lead to a jump in both the equity market and if RBI reduces the repo rate, it could also lead to more loan growth and more spending in the more private spending by the companies. So what I believe is that the future in the what I believe is that in future there could be both credit easing and then monetary policy easing, and further the equity market could stabilize. While in the near term it's not possible because of various uncertainties and the policies with respect to India and the world is actually not clear. But there would be consolidation in the by the end of this particular year or let's say in the next year. And so we'll see, in the equity market, we'll see some sort of stabilization. Thank you.